Now, when we talk about calendar spreads, as we said in the description and the definition, what we're doing is we're buying one, selling the other, or selling one, buying the other in the respective months. Now, the reason why this strategy has always been one of my favorites, it happened to be the first strategy that I implemented as a novice market maker on the floor of the CBOE in 1981. I actually stood in the pit and was trading a stock called Fluor, FLR, which is the big oil construction company and infrastructure construction company around the world. And I walked into the pit and I like practiced for a week making the markets on two options. One, for example, was in an October month, and the other was in like a September month. And what I was making sure that I was very sharp and cognizant of what my market was in each of those calls. Because what I was trying to accomplish when I was looking at this was, let's say if it was, in this example, I'm in BMW, which is a trade we're going to talk about. The market in the BMW 90, as you can see, is 210, 225, which is right to the left of that 90 strike, the bid ask in the red. And above that, you see the September highlighted in red, which is 30, 35. Those are both calls. The 30-35 market on the 90 strike in September. The 210, 225 market is the 90 strike in October. And what we're going to do here is we're looking at buying the October 90 and selling the September 90. And as you can see, we've accomplished that in a pricing of bid to offer. If you look here to your left, you'll see that if we were to buy the offer on the 225 OCT 90 call and sell the 30 bid on the SEP, we're paying 195, which is this 195 price where you see the cross. If we were to sell the spread at 210 and buy and sell the spread by selling the OCT 90 and buying the SEP 90, we'd be doing that for 210 against the 35 cents. So the market on the spread is basically, if you were standing in the pit making a market and someone said, what's your market on that spread? My market would be 175, 195, meaning that I would buy the spread by buying the SEP, the OCT 90 at 210 and selling the SEP 90 at 35, or sell the OCT 90 at 225 and buy the SEP 90 at 30 cents. So as a market maker, my market, if I was market making in the pit in open outcry, or even electronically, would be 175.95. Now what I'm trying to accomplish by that is, if you look at the theoretical value, which is the fourth column to the left of the strike price, you'll see that the SEP is 0.48 and you'll see that the OCT is 2.47. So basically, what's that work out to? We're looking at 199, right? Well, that's a theoretical value that's being created by the prices that were put in place from the night's close. So we've got a little aberration in the price of the markings. Whereas the PRED, I have it valued at probably around 187.5. So I'm trying to make a market in the middle at 175, 195. Now when you look at a time spread, the variables involved in the time spread are the strike, which is 90. If there's a dividend that is in the period of which we're talking, and then obviously the time between the days of the expirations. And as you can see here, we have 36 days and 8 days, so we're only talking a 28-day cycle between the two different strikes. But what really is great about a time spread is this. You can buy or sell a time spread depending upon the strategy that you're accomplishing, and either get bullish or bearish. And at the same time, you're doing two things. What you're doing is you're not spending a lot of money. You're not putting a lot of risk on the table, because as you can see here, when we look at the gamma, I mean, we look at the delta of these two options, we look at the OCT 90 has got a 35 roughly delta, and the SEP 90 has a 17. So if we're buying one and selling the other, we're only talking about 17 deltas that we're getting long. Okay? Now, a time spread has its greatest value at the expiry of the near month, right at or just a little bit above the strike that you're trading.